And for Nvidia, what's the state of play here? Because we've seen the stock down year to date. It didn't get that pop post GTC. What is going on?
Sure. So thank you for having me again, Brand. Really appreciate it. So let's talk fundamentals and then the stock. What we heard at GTC were a few important updates. Number one, for the first time, Nvidia actually outlined a path towards $1 trillion of data center spending over the next few years. And if we look at where they are today, it's only about 30 to 40% of that spending that continues to grow. There is nothing else on the planet that is as large or growing as fast. Point number one. Point number two, they went out of their way to explain to people how important this new industry of reasoning models and of test time compute, that this is a new class of models which actually takes extra time to think, but it gives you a lot more accurate answer. But that extra time to think results in computational demand can be 10 to 100 times more than what it is in traditional large language models.
It's crazy.
Right?
Exactly. How does that appear? Before we get into your third point,
sure.
How does that appear in our lives at some point?
Sure. So today, if you go and do a search, whether it's an OpenAI or other models, it's going to give you a best efforts answer. But as we start to use these models for applications that are a lot more mission critical, think if you're a lawyer, if you're a doctor, right? Self-driving cars. Right? So these are a lot more mission critical applications than just tell me what movies are playing right down the road. So in order for the industry, right, people always talk about what is the return on investment. The return on investment in large language models is going to come when this industry provides a lot more accuracy and reliability of answers, right? Think about, the analog I have in mind is, think about in the past when we used to have just simple cell phone service and then we had BlackBerry, right?
So I still remember typing BlackBerry.
Exactly.
I can do it with my eyes closed. I still remember the keystrokes.
Exactly. That was actually one of the first stocks I started to cover when I joined the industry.
RIM, right?
Yeah. Exactly, research in motion. So think about the power of that, having a VPN in your pocket all the time. So that is the thing, that as we start to make these applications a lot more accurate and reliable, and to make them more accurate and reliable, right, you have to go to this new class of reasoning models, right, where they are reasoning against each other, right, where they are getting data live, as opposed to just looking at all the internet data that was just there until 2021, because that was just the state of the art then. So that was the second thing that we heard, that the amount of computation required, right, is going up by a factor of 10 to 100 times. So when people freak out when they hear about a DeepSeek, they should not be, right? And here's the interesting thing. Since DeepSeek, have we heard anyone in China cut down their CapEx by 75%?
I haven't seen any of the hyperscalers cut CapEx at all.
Exactly. So CapEx has grown because they realize that the more compute you throw at a problem, the more accurate and reliable and the more the ROI becomes over time. So that was the second thing. Third was a multi-year roadmap. Right, Blackwell shipping now, Blackwell Ultra shipping in the back half, which takes up performance by a factor of 50% because of more memory. Rubin shipping next year, Rubin Ultra the year after, and then they launched a new product called Feynman that goes all the way till 2028. Why is this important? Because when you're Microsoft or Google and you're planning over multiple years to go and actually get power, right, generation, nuclear facilities, right, restarted, you have to have that multi-year roadmap. And only this company is able to provide that certainty of roadmap and supply chain. So I think we heard a number of these factors that tell us that in order to really take advantage of the AI industry, you have to partner with Nvidia in one way, shape, or form. So the next several years, we think growth rate stays very strong. Now let's talk about the stock itself. I think what we are seeing right now is our BofA strategist, Michael Hartnett, always, he has this 3P approach, which I find very useful, right? Profits, positioning, and policy. We just discussed the profit side, that Nvidia's sales growth, profitability, exceptionally strong, right? Take all the S&P 500 stocks, look at which is growing the fastest this year, right? That's the profit side, exceptionally strong. The positioning side is where I think we were perhaps a little bit off sides right? In the last few years, there was a lot of money chasing, right, some of these large cap stocks, including Nvidia, both institutional and retail, whereas a lot of money was taken out of international markets. So I think some of that positioning sentiment is getting de-risked. You know, at the start of the year, the SOX index was trading at a 30 times forward PE multiple. Now it's more like 21, 22 times. So some of that positioning, I think, fluff has been taken out.
Yeah, that seems cheap.
And now the policy thing, to the points you made before about the uncertainty, right, because of the policy changes here, that really impacts this global sector. So I think as the policy starts to stabilize, I think the positioning will start to come back in these names, but the profitability and the fundamentals are exceptionally strong.
News that tariffs on the semiconductor industry might not be imposed on April 2nd, the day President Donald Trump was supposed to declare reciprocal levies on imported goods, caused Nvidia to rise on Monday. Should I buy or sell Nvidia stock right now? Nvidia has outperformed 49% of all other companies in database in terms of its 12-month price performance. In just 4 weeks, that is a decrease from 86%. Although the shares are still below their 200-day moving average, they have cleared the 21-day moving average. Nvidia, the unchallenged world leader in generative artificial intelligence, AI-powered graphical processing units, GPUs, presented its future direction on March 18th at its annual GTC conference. Nvidia reiterated its dedication to ongoing innovation, development, and implementation. Over 3.6 million of Nvidia's current Blackwell GPUs have already been sold to cloud operators following the successful launch of Hopper GPUs, which sold over 1.3 million units. Amazon.com, Microsoft, Alphabet, and Meta. Meta are some of its biggest clients. It is anticipated that Nvidia would launch Blackwell Ultra in the latter part of 2025 and start shipping Vera Rubin in 2026. The business has made the decision to reveal its roadmap for Feynman AI chips in 2028 and Rubin next, which will be released in 2027. Pure-play generative AI models give way to reasoning AI models in Nvidia's latest chipsets, which is the main advance. By doing this, it minimized the issues with low-cost solution availability associated to Chinese DeepSeek. According to Jensen Huang, CEO of Nvidia, DeepSeek has created a big growth opportunity for his company, despite the market's perception that it poses a serious threat to Nvidia's expensive chips. Huang claims that the R1 AI model from DeepSeek is the first open-sourced reasoning model. Compared to a non-reasoning AI, this reasoning AI uses 100 times as much computing power. Other reasoning models include Alphabet's Gemini 2.0 flash thinking and OpenAI's O1. According to Huang, businesses who want to use reasoning AI-based infrastructure in order to save expenses and increase returns will find that quicker AI processors are the ideal choice. In this sense, it is anticipated that Nvidia's next-generation Blackwell Ultra chips, which are supported by their lightning-fast AI servicing capabilities for numerous users, will generate 50 times more money for data centers than its Hopper systems. Nvidia revealed new robotics AI infrastructure. In the future, Nvidia might see further growth from the automotive sector. Nvidia's self-driving platforms were the main factor fueling the expansion of the automotive category. The company is concentrating more on powering robotics, driverless cars, and ADAS. Nvidia revealed new desktops and laptops that employ its CPUs, including 2 AI-focused PCs named DGX Spark and DGX Station that can run big AI models like R1 of DeepSeek and Llama of Meta platforms. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
I've invested in Nvidia. Why are they selling the stock? To your point, I mean, what companies are talking about trillion-dollar total addressable markets, empowering robots and self-driving cars? Like, what's in their heads at this moment?
Sure. I think it's a matter of time frame. With any popular stock, whether it's this one, whether it's several of the other large cap tech names, it's easier to draw fast money, right? But this is an industry that happens over a period of time, right? You don't just go from doing simple conventional neural networks to large language models, to doing some of these reasoning models, right? All in a span of a week. It takes place over a period of time. The infrastructure part is still being built. I think that is what is creating this level of angst, that first the infrastructure has to be built, the tracks have to be laid, then the trains are going to come, and then you are going to optimize how much should I charge per passenger from this point to this point, right? We want to know how much should we charge passengers today. That is step 3 of the process, right? So some of it is, just the difference in timeline of different investors. And the other thing in hindsight is that, perhaps investors were underinvested overseas, right? And they were overinvested in the US. So some of this is a positioning statement. And of course, when you change these investments, the largest, the most liquid names, right, often tend to face the brunt, right, of that, in the early days. I think what will need to happen is that as investors start to get certainty about the US market, just as quickly we have seen the money leave, I think we might see a reconsideration, because remember, the world outside is still not as safe. I'm not a portfolio strategist, but how fast is Europe growing, right? How much can Chinese growth be dependent on for how long? Right? How much of that depends on episodic government stimulus?
Rather invest in Nvidia.
Exactly.
European asset.
I think
that's not a stock recommendation. I'm just making a comparison here.
So I think that's what needs to happen. That people have to go through looking at what's happening outside. Is that reliable, or is it more reliable as to what things are done? What's the quality of earnings here, right, etc. So I think these things are not uncommon. Since I've been covering Nvidia for a decade, I've seen the stock go down 40%. 3 times, and look at what it has done over long periods of time.
After GTC, I got a note in my box. You're sticking with a bullish rating and price target. Given the concerns that you're talking about, why not downgrade?
Right. First thing is, we have to first look at fundamentals, right? That, when we look at technology stocks, it's interesting that people always talk about valuation. Valuation is always important, right? It's always there in the background. But when you cover technology stocks, you have to first consider, is the size of the market growing? Is their competitive position growing? What is their execution, looking like? Are margins continuing to, expand? And they check every one of those boxes, right? But what has perhaps changed is that this transition from Hopper to Blackwell, I think, created a little more of an execution delay. It's interesting, if you look at the stock, it peaked last year. That was right around the time the gross margins peaked at 78, 79%. Now gross margins are 71%, right? So when we speak with them, we not only talk about what's coming down the pike, we also try to get a sense for how do they see this path of gross margins going forward. So from what they are describing, gross margins can get back to mid-70s. So we have come down, and I think if in the second half we start to go back, we are going to see the opposite of what we have seen, right, with the stock. So that, I think, is a very important point, that we need to see this execution come back with this Blackwell and the following class of products. So no, I think it checks all these boxes. As we start to see the margin recovery, I think the stock should follow.
Nvidia is still one of the best fundamental companies out of all the companies that you cover in your coverage universe?
Yes, and for the reason that, again, largest markets, fastest growing markets, right, best position to go after those markets. And oh, by the way, it is now trading at probably half of its earnings growth. And just to put that in context, if you take the S&P 500, it's actually trading over 2 times earnings growth. If you look at the other so-called Mag 7, they're probably trading 2.5 times their earnings growth. So I think it is also now checking this valuation box very impressively. So as we see, some of this market volatility subside, I do think fundamentals are going to come back.
For the current year, which ends in January 2026, Nvidia anticipates sales and earnings growth rates of 52% and 47.2%, respectively. Over the past 7 days, the consensus estimate for current year earnings has increased by 0.2%. For the upcoming year, which ends in January 2027, its projected sales and earnings growth rates are 22.6% and 24.6%, respectively. Over the past 7 days, the consensus estimate for next year earnings has increased by 0.4%. Nvidia's return on equity, ROE, is 112.33%, whereas the industry's ROE is only 6.44%, and the S&P 500's ROE is 16.98%. In contrast to the industry's net margin of 8.37% and the S&P 500's net margin of 12.65%, Nvidia now has a net margin of 55.85%. In comparison to the industry's PE of 28.33% and the S&P 500's PE of 18.31%. Its forward PE, price earnings, is 26.74%. Nvidia had $43.2 billion in cash equivalents, and marketable securities as of January 26, 2025, compared to $38.4 billion on October 27, 2024. The increases are mostly due to rising revenues, which have been somewhat mitigated by stock repurchases. Sequentially, the total long-term debt stayed at $8.46 billion as of January 26. Nvidia produced $16.6 billion in operating cash flow in the fourth quarter of fiscal 2025, up from $11.5 billion in the same quarter the previous year. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock.
Let's get into the charts. Let's talk volatility with Kevin Green. I also see VIX down below 19 kg, so it really seems like everything this morning is lining up pretty clearly.
It has been. And actually, if you kind of go and look at the intraday levels here, we did hit a key area of resistance, potentially 57.30. First area on the radar for me this morning when it comes to these levels and flows. But if we're able to break above this, 57.65 is what I got my eye out on. Starting to see some flows at the 57.75 as well to the upside. So obviously a little bit of bullishness going into the session. And if we do see a breakdown 56.35 here, Oliver, with your first area, intermediate area of support 57.10, and the reason why I have that on there, you can look last week, basically Wednesday and Thursday, we tested that 57.10, 57.15, but failed at both times basically. And so we had a really good close on Friday. We had options expiration as well, and we kind of know that seasonality wise, after the the March expiration, we actually do see volatility kind of crushed to the downside. That's conducive for equities moving higher here, and with this optimism, and hopefully it's confirmed by the White House. But if it's the optimism around tariff policy, maybe going to be a little bit more strategic rather than just across the board tariffs, then that could kind of fuel this equity rally moving forward. But really nice breadth this morning. I believe we have over 80%, 82% of stocks in the S&P 500 in the green for right now. And we're going to see how much we can actually move to the upside. I would say technically, if you're a bear, you're getting very close to that first zone of potential short zone. We filled that gap on the S&P 500 this morning that we've been kind of talking about between 57.04, 57.30. We're testing that gap and pretty much filled that gap right now, hitting the 20-day moving average, getting very close to the 200-day moving average, which will be that key area here. And so we need to see a little bit of follow through, but overall, MACD is crossing that bearish formation. We talked about this last week. It looked like it was going to be on that trajectory to do so. You could expect maybe 2 or 3 more sessions to the upside at least, potentially, if that indicator is going to hold. Market breadth expanding, RSI trying to make higher highs and higher lows after getting over in that oversold territory here. So setting up to look, pretty decent. I don't think that we're out of the woods yet. I would say that you get a little bit more confident if you can break above 58.50. That would get you a little bit more confidence. That's that next area of significant resistance when you're looking at the candle chart on the daily. So good move so far. We just got to hold this and hopefully have more gains for today too.
And I think right now, if you're optimistic, if you're bullish, you don't have to think we're necessarily out of the woods to have a very tradable opportunity. You could fundamentally think that there's still policy risks. You could think there's valuation risks. You could think if you have conviction on the economy, that arguably there's slowdown risk. I think all those are still fair game analyses, but there's also still 400 points from here to the all-time high. So there's a lot of room, it seems, for us to find support without necessarily being completely out of the woods. So that's where I'm curious on the positioning that you watch. Short to intermediate term, is there a level that's intolerable for big traders to the upside, for institutions? Is there an area that we get squeezed that creates one of those kind of vortexes of options flow to the upside?
It would be above that 50 period moving average. So let's say the 59.15, 5,900 level is where you kind of get that that vortex, if you will. That 50-day moving average, if you kind of go back in time, either in corrections and or bear markets, that one is actually the biggest headwind that we have seen. So we could have counter trend rallies up to that particular point, but that's where you usually do see failures. I will say, though, if you kind of look at this right now, we go back to this example of, is this October 2023 or is this January 2022? Because the technical landscape and how we're kind of mapping out from just the chart standpoint kind of mirrors both type of scenarios here. If you think that we're in the October timeframe, then we have a lot more room to the upside. You're talking about another 15, 20% to the upside here, and then we kind of coast. If you think this is the January type of January 2022 style of an event, you're going to have these intraday or these counter trend pops to the upside and then massive sell-offs that occur right after. And I kind of go back and look at the weekly chart, and we can look at the weekly chart on the E-mini S&P 500. That'll actually give you a little bit more clarity as to what I'm talking about. Are we going to basically skip off of the 50-period moving average on the weekly? Are we going to basically break above the primary trend line, which we have broken, which is sitting at 5,900 on the E-mini S&P 500? That could be the case. Are we going to see kind of this rock skip off the zero line on MACD? That could be the case. That's exactly pretty much what happened in October. But if we do not, and this is kind of that first wave of a three-wave pattern, which you can make that case as well. If you are a bear, you come back up, test around 5,900, 5,950 on the E-mini S&P 500. More shorts kind of get back into the market, and you have this scenario where stochastics kind of still makes lower lows, which I have that at the bottom here. So I think it's still a very tactical market here. We're going to be in a lull where sentiment indicators right now have been very bearish. The market's been pricing that in. Tariff risk policy has been bearish. The market has been pricing that in, getting a little bit of a bright spot here. But the hard data has not shown any of this real slowdown in the market. And until that actually happens, bears are going to need to have another catalyst to break the market down. The market just doesn't break down because of no reason. You need to have continued catalysts in order to do so here. So I think this is a decent little pop. I would be very tactical with it. I would look at that 200-day moving average as your first short zone that you see maybe some sellers kind of getting in, or those that did buy the low, taking some profits at that level.
At the moment, Nvidia is ranked number 2 by. Nvidia's stock has grown at a rate of 10.5% so far this year. At the moment, the stock is trading at a steep 30.1% discount to its 52-week peak. The stock appears to be quite profitable at current pricing. Brokerage firm's short-term average price objective for the stock is 49.69% higher than the stock's most recent closing price of $117.70. At the moment, the brokerage's target price is between $220 and $130. This means there is no downside and a potential upside of 85%. In a market with trillion-dollar potential over the next 10 years, Nvidia is a major player. Its EPS growth rate for the next 3 to 5 years is 25.7%. which is far higher than the S&P 500 index's growth rate of 12.7%. Nvidia offers a unique chance to invest in a business that has demonstrated success and significant untapped potential in the AI revolution. Purchasing this stock now and adding more on each downturn will be wise. Long-term investors should hold on to the stock because of the company's solid performance over the last several quarters and its optimistic outlook for the future, which will increase value. As a result, Nvidia's stock price ought likely see an alluring increase. The price performance of Nvidia for the current year is displayed in the chart below. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.